Hello and welcome to this BeeBusinessBee vlog, where we're going to start to look at the topic of futures and options and hedging and what does it all mean. Three economic words you'll hear quite a lot of times said. However, what do we actually mean when we talk about those terms? Now, firstly, I want to look at what is hedging. Now, hedging is a fancy term for insurance. Every single one of us probably has taken out some form of insurance to protect ourselves. So when you're doing hedging, it's just a financial term that means you're trying to protect yourself. Now, you might be hedging against currency or commodities. However, I bet many of us have hedged against our mobile phone when we're taking out insurance to protect us, just in case that time when we break our phone. That's exactly what hedging is. It's a fancy term for insurance. Just in case, shock horror, the worst was to happen. Now, as a company, when you hedge, you tend to have two options. You can have something called futures, or you can have options. Now, a futures contract is exactly what it says. It says you're going to agree to pay for something and buy it in the future. So you are effectively saying, we will buy that product for that price. So if you want to think of a simple example, imagine a commodity, imagine the price of sugar. So for example, we are buying in sugar from overseas, and our supplier says, we'll give you the chance to buy at a set price in the future, guaranteeing that price if you will sign the deal now. So that might say that, let's, for example, say we're going to buy every single bag of sugar for £1. Now, what we're gambling on there is the fact that the price isn't going to increase, because obviously, if the price is to increase, it's a great win for us. So we're going to be laughing because we're buying at £1, and let's say actually it's going to be £1.20 a bag, so we're better off. But if the price was to go down, so let's say 80 pence a bag, we just sign a deal where we have guaranteed to say we will pay £1 per bag of sugar. Now, of course, that happens in the financial markets, and it happens with currency typically. So if you are an importer, for example, and we all know you want a stronger pound. So you want the stronger pound, and let's think about this. You're probably being offered a chance to maybe purchase your dollars. Let's say £1 is the equivalent to $1.8, for example. Now, that's giving you the option to purchase. Now, you can take that option up. That's pretty good. It's quite a strong, obviously, pound to dollar ratio. However, let's just say that actually the pound got a lot stronger. It got massively stronger. So then as a result of that, actually the pound's now worth £1 to $2. Now, of course, we've agreed a contract that we're tied into. So we're worse off. We're effectively losing 0.2 every single time we bought a dollar there and that essence there. But we've agreed that contract because we would be better off if it doesn't rise by that amount. Let's say that actually the exchange rate is actually £1 is equivalent to 1.5. Or because we've agreed to buy at 1.8, we're miles better off. And that's why that insurance paid off. Now, that's a futures contract because we have tied ourselves in. We've got no way out of that. Of course, you can do something called an option. And the key word there is option. You buy the right to choose to exercise the option. So if you think about that example that I just talked about, we would have the option to buy our currency at the $1.8. Now, if, for example, we said there the exchange rate was £1 to $1.5, of course, as an importer, we are going to exercise that option because we're better off. However, if on the market at the moment, what they call the spot price, effectively, it is probably £1 is equivalent to $2, then we wouldn't choose that option. So we wouldn't buy it. We'd just give up that option. So we effectively lose the money we paid for our contract and the right to have that option, but we just don't take the option up. And that is the difference between a futures contract and an option that you might take. And that is one of those things that people need to consider when they're thinking economically about hedging and limiting their risk. So when you hear that word hedging, just think it's a type of insurance. And I take out insurance all the time. And when you think about futures and options, just think, well, an option gives me the chance to take that insurance, where the future is tying me into the insurance. Thanks for checking out the BeeBusinessBee YouTube channel. Don't forget to click the subscribe button down below to subscribe to our YouTube channel. Don't forget to follow me on Twitter. It's at BeeBusinessBee. Also, give the Facebook page a like. It's facebook.com/BeeBusinessBee. And lastly, don't forget to check out the online hive of activities found on BeeBusinessBee.co.uk, full of quizzes, activities and resources. And remember, until next time, keep buzzing.